Hello everyone, TGIF. So before I begin, can I check if you guys can hear me loud and clear, no lag at all? Okay, great. Okay, so welcome to our yearly webinar. So this is a yearly webinar because I rarely give public webinar. Okay, so this usually happen once a year, or if you are lucky, maybe twice a year. So can I have a show of hand who first time here? Whatever webinar, who first time sitting at a webinar that I host? Virgin, who's the virgin here? Anyone, don't be shy. I'm seeing a lot of new names, so my community people are not here. I mean the majority of the people here are new people. I don't really see a lot of the folks from my community, and I think it's also mainly because like they are kind of they are kind of sick of me talking already, like keep hearing the same thing. Like the other day during our community webinar, one of the guy asked like, so where what do we have to do to make you stop talking or repeating the same thing? But I mean in a joking manner lah. Okay, yeah. I do see a lot of new people. So anyway, I would like to thank you guys for spending your Friday night with me, and let's go through some of the trading stuff for 2026 lah. Okay, so anyway, for this session, the video is recorded and will be uploaded. I will tell you where it will be uploaded later. The PowerPoint will also be uploaded, so you don't need to do like a lot of screenshot or taking down of notes or whatever lah. Okay, you just sit there, pay attention, can ready. Okay, so let's begin. Our yearly webinar 2025 review and 2026 opportunity. What are the stuff available for us to trade, or what are some of the things that we can take advantage of? Oops. Okay, so let's start off with a disclaimer. We are only covering the stock market and mainly the US market. We will not be covering Hong Kong, Singapore, Forex, or commodity or crypto, those kind of stuff. Okay, we are mainly equity traders and US equity traders. So our trading framework only applies to the US market. So we cannot suka like apply the same strategy to the China market or Singapore market or Malaysia market, mainly because the way US economy function is very different from how China function or how Singapore function. Okay. And our framework is for trading purpose. So we are traders, trading community. We are not here for long-term investment. Okay, so very different. Trading versus investment. We are not here to buy and hold, but rather we are here for very active portfolio management. Okay, so today's agenda, firstly, there will be an introduction, basically introduction about myself, okay, especially for those who are first time here. Only one person raised their hand, but I'm sure there are quite a number of you first time here also. I'm seeing names that I never see before. Okay, then I'll go through 2025 market performance, the best and worst trade for 2025. I'll go through a bit of common retail trader mistake. So if you are a retail trader and you are looking to improve your trading, it is something that you can take note of. And what is actually the institutional trading framework? What are the hedge fund people at JP Morgan or Morgan Stanley? What are the kind of strategy are they using? And then we will go to 2026, what to expect, and 2026 potential trade. So I'm very sure most of you are here for that. Okay. Unfortunately, you have to stay until then. So, and then we have how to connect with us or join our community. And finally, I'll open up a Q&A to the floor. So if you have any questions, right, please take note first, like write it somewhere, and then during the Q&A you can ask your question, because this is mainly for the experience of those who are watching recording. Okay, imagine you are watching the recording and then suddenly someone asks question and then now you lost track of what of the actual presentation that is being given. So it is going to be pretty long. I'm guessing about 2 hours. Most of the time when I do this, it will always go beyond 2 hours, mainly because the Q&A session tends to be very long. A lot of people are asking questions. So even though I put that 15-minute, right, if I have a lot of questions coming in, I don't mind staying. Okay, I like to entertain questions, especially if they are very reasonable and legit questions lah. So this is my CV. Even though I don't have my video on, my webcam on, right, mainly because I'm in my pajamas ready, right. This is how I look like back in 2018. Currently, right now, I'm a little bit more plump, more fatter lah. Okay, so you can like increase this size by 50%. Okay, so my academic background, I have bachelor degree in molecular biology and bachelor degree in chemistry and biological chemistry. So mainly the biotech chemical area. Okay, so I have 14 years of pharmaceutical industry, 14 years in pharmaceutical industry as a molecular biologist and chemist. So nothing financial related, not even in finance related field at all. So a lot of my trading experience and learning are self-taught, and also mainly from begging all the professional traders lah. Okay, I will go and hound them and beg them to teach me. So my retail trading background, I start all the way back in 2013, so it is about 13 years already lah. Okay, very very long. I started trading with 30K. 2016 is my first profitable year. 2019 grew trading account to 90K. During this period, I added more funds lah. So it is not 30K become 90K lah. Okay, I think I added about additional 30-40K like that. 2021, I left my full-time job at Roche, became a full-time trader. I internship as an analyst in a London-based hedge fund, currently under NDA. I founded Nimbus Capital Solution, a trading education company, which is how you know me from, which is where you know me from, and which is why you are here lah. Sorry, I have, let me take a look. You can't hear the audio. Can you all hear me? Just now when I ask for people say they can hear. Han, can you like check your audio? Thank you. Okay, and in 2023, I grew my trading account to 200K, mainly from the COVID-19 lah. Okay, 2020 was like whatever you buy, you are bound to make profit lah. Okay, so it's a very easy trading period. 2024 founded Protege 9 Holding, a private fund, and 2025 managing a trading account with combined AUM of $700,000. So area of expertise in trading, mainly the US market, quantitative and qualitative macroeconomic analysis, comprehensive fundamental analysis, options, portfolio modeling, hedge fund trading strategy, and long-short portfolio management. So just to go through what are hedge funds. So hedge funds are something that a lot of people like know the terms, but they don't exactly know what are hedge funds. And for a lot of retail trader, they will bundle hedge funds with all the institutional fund, mutual fund, index fund, whatever lah. Okay, like to most retail trader, they are the same thing. But in fact, it is not, because hedge fund is like a very small, tiny subset of trading funds lah. Okay, so it is an alternative investment vehicle that use specialized hedging strategies across various assets. So you are not a hedge fund if you are not hedging lah. Okay, so the key difference here is hedge fund hedge. So some of the hedge fund strategies are things like long short equity strategy, or LS, equity market neutral, short only strategy, event driven funds, arbitrage fund, activist fund, global macro funds. So for my own personal trading strategy, and what I use is basically the long short equity and equity market neutral. And these are all event driven funds lah. Okay, we are using certain events as a catalyst for the stock to move. So these are some of the videos that I have posted previous year. So as I said, right, we do this every year. So this was 11 months ago, which is about 1 year ago lah. Okay, and this one was 2 years ago. So if you are here, right, good for you, because you will probably not get another webinar until next year. Okay, so let's do 2025 recap. So this is overall return for the US stock market. Okay, and we can see a few interesting things here. Firstly, number one, the S&P. S&P actually kind of underperformed overall. So if you look at SPY, right, for the entire of 2025, the return was 16.8%. Nasdaq actually returned a little bit higher at 20.17%. But if you look across individual sectors and other niche specialized sector, or even commodity like silver, gold, right, 2025 is not really a good year for the overall US indices, okay? Meaning to say, if you are diversifying elsewhere, or if you are picking certain stocks, if you are specifically going for a particular stock, right, highly likely that you may be able to outperform the S&P 500 very, very easily. So just to like highlight a few interesting one, the emerging market actually outperformed S&P 500 at 34% return. And in fact, for 2025, Hong Kong actually outperformed the US market. Singapore also outperformed the US market, which is very, very rare. In fact, I was kind of surprised to see that. And this one, I think should not come as a surprise. Silver and gold definitely the best performer for the year. Silver coming in at 144%, gold coming in at 62.29%. And in terms of the bond market is pretty much very, very flat, nothing ongoing over there. If you look at specific sector in the US market, definitely the tech sector is performing the best at 24.4%. So if you simply just invested in the tech sector alone in this ETF called XLK, then you have outperformed the US market, okay? And the worst performing one is actually consumer staples. Consumer staples not doing that great, okay? So if you look at companies like Coca-Cola, Pepsi, General Mills, Target, they are not really doing that great. And uranium ETF also performed 63%. Aerospace defense performed at 53%. And the worst one for the year is actually Bitcoin. Bitcoin is actually down 47%, which kind of dislocate from the Nasdaq. Okay, most of the time Bitcoin tend to move with Nasdaq, but for the year 2025 they kind of like dislocated. And then we have the US dollar index down 8%. 2025 was quite weak for US dollar. So these are all the stuff that happened in 2025. So this is my portfolio historical return from 2020 onwards. So it is yearly return, okay, year over year return. And you can see most of the year I can average about 40 to 50%. Some of the year can outperform, but recently 2025 severely underperformed compared to what I usually get. So for the year of 2025, my performance was only 21%, which is barely beating Nasdaq performance. Okay. So let's take a look at how I performed for 2025 real quick. It is also important because from trading perspective, right, you have to understand that there are a lot of things can happen and losses are part and parcel of trading. Okay. So firstly, you can see here, I made a total of 168 trades. 91 are profit, 77 are losing. So in terms of winning rate, it's about 54%. The starting capital is 300,000 USD. Total profit from all the profitable trade is about 500,000, 500K. But I took a total loss of 482 million, which gives me a net profit of $62,000. So you can see that actually losing is a huge part of trading. Okay, if you are here to trade, right, you cannot scared to lose, because if you scared to lose, then obviously you are not going to do well. You will forego a lot of opportunities, or you will end up losing more than what you initially intended, or what you initially sort of formulated. And you can also see I took a lot of bullish position, definitely more than bearish position, which is quite normal for every year. Most of the time the stock market is going up. Okay, so you want to be more bullish than bearish, but because we are doing a long short portfolio, we cannot disregard bearish position. And you can see here, there are winning position in the bearish position. So I am still profitable on all my short trades net, okay? On a net basis, I am still profitable on all my short trades, but of course the bullish position is actually more profitable in this case lah. So there's only US counters, there are no Hong Kong or Singapore counters. And you can also see the duration of my holding time frame for my trades. The average duration is about 34 days, so it's about 1 month lah, okay? The median duration is about 28 days, and you can see for majority of the trades is between 10 days to 60 days lah, okay? And most of them fall somewhere around 30 days like that, which you can see here lah, okay? So we are basically trading fund, a trading strategy. We are not looking to hold for very long. Of course, there are some trades that I held past more than 60 days, but they are like break even now. Okay, some win, some loss lah. But of course, we also have certain trades that like we buy for speculative purpose and it's closed out within less than 10 days. So this is just to show you that if you are looking to trade, right, this is the time frame that you should be looking at, about 30 to 60 days. And from a win-loss ratio perspective, right, highly likely that you're gonna lose as much as you win, okay, from a winning rate perspective. But those trades that you win, you want to win more than what you are losing. So for example, losing trade, maybe you are losing $3,000, but winning trade, you are winning around $5,000, something like that, okay? So, and you can also see here, the performance was quite all right until towards the end of the year where there's a big drop off and then there is more drop off towards the quarter four, okay? So this is something that I will show every year. In last year I show for 2024, blah blah blah. So if you guys are in my community, or if you have come for the course and you graduated from the course, right, you actually have full access to what is actually in the portfolio, what are the trades coming in and out of the portfolio. Okay, so best trade for 2025 axometry. So this one come as no surprise, especially if you are active on our Facebook or Discord or wherever, okay? So this is, in fact, the bulk of 2025 profit actually come from axometry. We have profit screenshot from like some of our community member and myself. So in fact, I personally gain more than about $50,000 from axometry, this one trade alone, because we keep compounding the trade as it climbs up, okay? So we got it during this period, and that is our best performing trade. And then we have Argon, which it was somewhere around here, and then we have Alcoa, which we got somewhere around here, and currently is sitting at $63, but we didn't get the whole stretch, okay? We actually exited pretty early before the big rally came in, and we didn't even we didn't even go back in. But sometimes certain trades we will keep entering in order to trade the trend, okay? But this is something that we kind of like miss out, even though it is going up very, very high. And if you guys are in our channels, in our public channel, we actually gave out Alcoa trade as a freebie trade for the public, and axometry also was given out as a freebie trade for 2025. Like, you don't have to be even in our community or our course, but of course not every year we will be this lucky, okay? It just so happened that for 2025, the trades that we gave out to the public for free happened to be the one that performed the best. So hopefully 2026 we can repeat the same luck, okay? So in fact, if you look at our Discord channel, we don't just give out trade like, hey, you go and enter this, but we actually provide our research report, provide our thesis report. So the way we do our framework, the way we search for trades, identify trades, doing all the fundamental analysis, we actually have a proper trade report that comes with it. No trades in our framework will be entered without a trade report. There will be a accompanying trade report. And this is something that a lot of retail traders are lacking also, because they don't really write any trade reports. They just hear the trade from somewhere, some website, some Facebook post, and then they simply just enter without any kind of further analysis on it. So of course, going through the best trade, we must also go through the worst trade, okay? So this is one of the worst trade, Lululemon. Just to kind of put everyone on the same ground, there's no such thing as the worst trade because you have a stop loss. If you are playing options, your option itself is your stop loss because you simply cannot lose more than your option premium. So in this case, right, if you are going to lose money on your trades that didn't go well, you should be cutting your losses, you should be exiting your option position, and whatever your losing trade is, you should be losing like the same amount of money, okay, which is basically your risk. So if I'm risking like $3,000 per trade, right, almost every trade I should not deviate too far from $3,000. So from this perspective, right, all my losing trade theoretically should be around $3,000. There is no such thing as worst trade. But of course, as human beings, right, even someone who can trade profitably, I am also a slave to human emotions. Okay, sometimes I can be overconfident, sometimes I can be stuck in a certain position, and then I end up losing more than what I should be losing. Okay, so in this case here, the worst trades are actually trades that lost more than what I have intended. So in this case, there's Lululemon here. You can see I lost close to about $10,000 on Lululemon, and in fact the entry was somewhere around here, and then earning there was a very big gap down, and then I continued to hold on to the position, and then I sold covered call, and then I was hoping that the next earning can go up, but it kind of gapped down again. Okay, so the loss was quite outsized. So this is a very good example of low can go lower. So in this case here, right, the issue here is I wouldn't really blame the trade itself because they are bound to be losing trade, but in this case it is a mismanagement of risk, totally preventable. And this one, the next one is definitely the most famous one if you guys are in the community, Chemo company. So unfortunately for Chemo, I entered it right at the top and I actually exited right at the bottom, mainly because the risk was too much and I realized that I cannot hold on to this trade anymore. And you can see here in the past few weeks, it kind of recovered back up. Okay, unfortunately for this trade, I got quite overconfident and the position was very, very big. And you can see here, this is the single largest position in my trading career. Is very close to $50,000 on one trade loss alone. And in fact, it is because of this one mismanagement of the trade that caused 2025 to be the performance to be very, very bad. So if you like ignore this trade, right? If you kind of like instead of losing $50,000, I only lose $3,000, then the performance will be close to my average. And the next one is EchoStar. So EchoStar is actually a short position, but you can see here how the stock actually rally. So this is one of those trades that I would say cannot be prevented, cannot be managed in terms of risk, because when we play the short position, I actually shorted here because the earning was very bad. In fact, the company's the fundamental is very bad. But what happened was somebody came and buy over part of the business. So there was part of the business that was being bought out. And because of that, right, the stock actually went up 80% in a single day. Actually went up 80% in a single day, and there's no way to take the loss anywhere in the middle. So the moment market open, right, you are in a very big loss really. Okay. So in this trade here, you can see I have an option position here. So the option position lost about 5K like that. You can see option position lost about 5K like that. So this is one advantage of options also, because when you play options, right, your loss is actually fixed. It doesn't matter how high the stock goes, you will only lose the amount that you pay for the premium. But unfortunately, I also have a very, very tiny stock position, and this stock position initially the risk was only $2,000. Okay, I'm using the word only because based on my portfolio capital, which is at 300K, right? This is actually considered quite tiny, lah. Okay, but that $2,000 risk, when this very big gap up came in, it turned into a $34,000 loss. So this one definitely lost way more than expected also. So because of the 80% rally in a single day, this is what we call a takeover risk or gap risk, where the stock suddenly gap up way beyond your stop loss level, and it's very hard to manage your risk. So this is one of the situation where you totally can't do anything about it. The only thing that you can do to manage this sort of stuff happening is to basically play options, because options simply just cap your risk altogether. Okay, so now with that said, right, let's go to common mistake made by retail trader. So binary mindset, a lot of retail traders are like this or that, bull or bear, up or down, recession or no recession, positive beta portfolio. So I will go through a little bit more on what is positive beta. Do not understand what proper diversification is. A lot of retailer thinks that they are diversifying, but they are actually not. In fact, they have this, they are like brought into this fake sense of security because they think that they diversified, but actually they didn't, and then end up sometime when their portfolio goes in the opposite direction, right? They get very confused. They'll be like, "Hey, I diversify what?" Then have no idea what happened. Overly focused on technical analysis. Institutional trader pay little to no attention to technical analysis. So this is for traders, okay? Even for traders, right? Institutional trader don't care about technical analysis. But a lot of retail trader already have this misconception that if you are trading, you use technical. This is one of the stuff that is being taught by a lot of courses out there. But in fact, in a professional level, we hardly use technical analysis. Uh, and they ignore the fundamentals and macroeconomic impact on trading. Overly focus on picking the right stock than the overall portfolio. So for professional traders, they focus on the overall portfolio. How is the overall portfolio doing? Every decision is made based on the entire portfolio, not just that one single stock. So pay little or no regards to the overall portfolio management. So what they do is they just enter a trade and then they forget about it. So it's an enter and forget mindset. Hit the stop loss, then exit, hit the profit, then exit, that kind of mindset lah. But they do very little life risk management. Only focus on well-known companies like Nvidia, Palantir, Tesla, etc. Okay, they don't know how to spot some of the what we will call hidden gems. Okay, that's hiding. There are US market is very big. There are a lot of opportunity that is not in the limelight, and when these opportunities pays off, right, it can bring a very, very big amount of profit. For example, one of the example that I showed you earlier, Axometry. How many of you heard of Axometry? Most likely no, because everybody is trading Nvidias and AMD and Teslas and stuff like that. Do not document their trade thesis. They if you don't document your trade thesis, then you have no idea why you are entering. Probably because you heard the trade from somewhere, you read some article, you saw some Facebook post, and then you simply just enter a trade. So there's a lack of framework and there's a lack of oversight. And because you do not have a documentation of your trades, right, it is impossible to do any kind of post-trade review. So there's no feedback loop where you get to improve yourself. That process is simply not there. Do not understand beta hedging, which I'll go through later. Do not understand what is volatility. So volatility is something like diversification. It is a word that retail trader thinks they know, but they don't really know what it is. It's just a word, okay? So limitation with the current trading strategies. So most trading strategies like investment fund, unit trust, institutional funds, they are what we call beta funds that achieve beta returns. They are all long position only. So for a lot of traders, most of you are just buying, and buying. You are looking at what to buy. You don't really short stuff. In fact, there are a lot of people who are uncomfortable with shorting stuff. So beta returns refer to a portion of investment return that is attributable to the performance of broader market or benchmark index. It is directly related to the beta coefficient, which measure the asset sensitivity to movements in the market. So beta funds follow the movement of the benchmark, and in this case, it can be the S&P 500 or it can be the various MSCI index, okay? And a lot of beta funds, what they do is they will try to outperform the benchmark. So a lot of people will say they outperform S&P, they underperform S&P, stuff like that, right? They are matching the portfolio performance to the index fund, and that contains a flaw, and that is, what if the index fund doesn't do well? Like in 2022, S&P fell about 30%, 30 to 35% like that. And if the S&P falls 35% and your portfolio fall 30% with it, then it is not a good thing. As a trader, you want to be making money in all kinds of market condition. If in a bear market condition, in a short correction movement, any kind of movement, whatever it is, you want to have consistent performance. So retail trader strategies are similar, as they will attempt to catch the market trend via various indicators and screeners. Retail trader tries to outperform the market through leverage instrument, because if you are trading the index and you want to outperform the index, the only way to do it is through leverage instrument really, okay, like CFDs. So there are a lot of people who trade CFD, index with CFDs with 5% margin, without realizing that they are increasing their risk as well. So from the perspective of risk-adjusted return or Sharpe ratio, beta strategies severely underperform compared to alpha returns that are generated by institutional hedge funds. Beta strategies which retail trader employ are at the mercy of the market direction and market volatility. So this is an example of a very typical retail trader portfolio. So if you look at this portfolio, what you see is all the very famous name, okay? This is a 8-position portfolio, and each position are allocated equally. So each position is about 12.5% allocation. You have Apple, consumer electronic, Amazon, internet retail, Tesla, auto manufacturer, Microsoft, tech software, Nvidia, tech hardware, Occidental Petroleum in energy, oil and gas, Visa in financial consumer credit, United Health in healthcare. So this seems like a very well diversified portfolio. Majority of the Max 7 is there, okay? And if you look at the right hand side, right, the right hand column, you have the beta value of each stock. So the beta value of each stock tells you how much is the stock correlated with the S&P 500. So Apple have a beta of 1.28, and what this mean is, if S&P move 1%, Apple may move 1.28%. Or if S&P goes down 1%, Apple goes down 1.28%. S&P go up 1%, Apple will go up 1.28%. But this is on an average basis, okay? It is not like today S&P go up 1%, then Apple go up 1.28%. No, but it is on a rolling average basis. So if you look at majority of the stock here, you can see that the beta are very, very close to 1, and only Tesla have a very high beta at 2.11, but the rest are kind of like close to 1. Okay, Nvidia have 1.79. Okay, so if you look at it, right, and if I take the average beta of this portfolio, which is very simple because the allocation is all the same. So what you do is you just add everything up and then you divide by 8. You get a average portfolio beta of 1.34. So if your portfolio have a beta of 1.34, then your portfolio is actually highly correlated with the benchmark, in this case at the S&P 500. So highly likely that wherever the S&P 500 goes, right, your portfolio will follow, but it will follow with a slightly higher magnitude, okay, at 1.34%. So limitation with the current trading strategy, the trader may feel a false sense of security because he thinks that his portfolio is diversified across different sectors. You'll be asking, okay, I got software, hardware, consumer, healthcare, financial, this is a all-weather portfolio. It can survive through any kind of recessionary risk, whatever. But when the market crash, right, that portfolio is gonna crash as well. So if the market were to drop, his portfolio should be able to weather the storm. Unfortunately, the portfolio is very highly correlated to the market. So on an average beta of 1.34 suggests that every 1% downside on the market, the portfolio will decline by 1.34%. This portfolio is beta positive and it is at the mercy of broad market movement. So if the market crashed sufficiently enough, like 2022, it is most probable that all the positioning in the portfolio will be stopped out and the trader will suffer a huge loss, a very, very big drawdown. So the diversification across different sectors, right, didn't really help. The trader thinks that he is diversified, but in fact, he's actually not. So as a trader, we want to achieve a portfolio that is close to beta neutral through beta hedging. And this is where we will achieve what we will call the alpha return, an overall return regardless of market direction. So if you are beta neutral, you are kind of independent from the broad market really. And you don't really care where the market is heading. Market go up, market go down, doesn't matter because your portfolio is beta neutral. And if you are picking the right stock, your portfolio should be going up. So the question here is, of course, how do we achieve this? And let's go to the institutional trading framework. So this is how the professional trade. So a disclaimer here, of course, in order to become a professional trader who can work at JP Morgan or whatever, right? It takes years and years of understanding of a lot of the financial process and the regulatory stuff. But I am giving you a crash course, okay? I'm giving you a very fast crash course. So by no means, like after this session, you can go and apply all the stuff already. No, it doesn't mean that. That there's no way you can apply something that like 20, 30 years of literature being squeezed into 1 hour of webinar. You definitely cannot do that, okay? But what this webinar will serve is it will expose you to what is actually going on in the professional environment. And I'm sure you guys have been through a lot of courses, a lot of advertisement that teach you things like, oh, this is what the smart money doing, this is what the big boys are doing, the trading syndicate are doing. I'm afraid to tell you that all those are nonsense, okay? All those are wrong because I have seen all the materials before and those are definitely not what the professional traders are doing, okay? So just to go through a little bit of what is hedge funds again. So generate positive return uncorrelated with the broader market, meaning beta neutral. And how do we achieve this? We achieve this through long short equity. And since we are trader, right, we are not trying to hold the portfolio for like over 2 years. We are event driven, meaning we will look at certain event in order to push the stock and we will go in and out within 30 days and we will get our profit or we will take our loss, whatever, okay? So long short portfolio strategy. All institutional hedge funds employ the same strategy, long short portfolio. We structure our portfolio with both long and short position to get a beta neutral state while still maintaining a sufficient portfolio volatility to get absolute return. So beta is the measurement of your stock portfolio performance relative to the market. Most trading strategy and investment funds are beta positive. So if the market does well, the portfolio does well. If the market crash, then the portfolio crash. So by structuring our portfolio to a beta neutral state, we become independent from the market. We are able to generate profits regardless of market performance. And this is what we will call absolute return because our return is not dependent on the market direction really. So this is actually our edge. And hedge funds are called hedge funds because they use long short strategy. The fund is always beta hedge against the market movement. So the goal of a long short equity strategy is to remain market neutral, or in the other words, beta neutral by constructing a portfolio with equal number of long and short position. So example, you have 4 longs and 4 short positions, and you have a 8 position portfolio. So the long positions are company with strong fundamentals. So this is like summarizing to one sentence. Okay, of course, there's a lot more things go into what qualify as a long position, and the same thing for short positions, company with weak fundamentals. So stocks are chosen based on fundamental factors, such as but not limited to things like earning growth, sales growth, expanding margin, etc. For all positions, an immediate catalyst must be present because as traders, not investor, the most common catalyst we look for is company earning release, which occurs every 3 months. So every 3 months, you have a catalyst coming in. So basically, what we will do, we will cut the loser and we will let the winner run. So this is a very rough theoretical rundown of what is supposed to happen, okay? But it is also pretty much dependent on how you pick your stock and how you actively manage your portfolio. So imagine this neutral portfolio. You have 8 positions, 4 of them are long position, 4 of them are short position. So there are 2 possible scenarios. Firstly, the market can rally. So when the market rally, right, what's going to happen? All your longs are going to profit and all your shorts are going to lose. So of course, when your short are losing, right, you're not gonna like hold your shorts until you lost a huge amount of money. You will cut your losses. At some point, if it hit your stop loss level, you cut your losses and you will let your long position run. So typically, your long will have more profit than what you are losing on the short. What happened if the market crash? The opposite happen. Now all your shorts are making money, all your longs are losing money. And once again, definitely you're gonna cut your losing trade short and you let your winning trades run. So regardless of what happened, wherever the market goes, there's profit because between your long and short, you are up $100 regardless of where the overall market is. So this is like the rough theory behind a long short portfolio, okay? But of course, the execution is very important. How you choose your stocks is very important. And a lot of hedge fund managers, right, where they differ is based on execution most of the time. They don't have 4 long, 4 shorts. Maybe they have 5 long. Okay, maybe in a hedge fund portfolio, there's like 100 positions. Okay, they have like 70 long position, 30 short position, that kind of stuff. Okay, and a lot of professional funds, you will use derivative, also mainly options to do a lot of hedging to improve the hedging position, especially when your portfolio is like in hundreds of million in size. So you need to do a lot of risk management. So long short portfolio strategy, as a summary, when we enter or exit trade, we must look at the portfolio as a whole. New trades added to the portfolio will affect the overall portfolio beta and volatility. So does exiting and removing trade from your portfolio. So your portfolio act as one team and each position is dependent on another position to ensure that the beta neutrality is being maintained. So you think of your portfolio like a soccer team. They are the attacker, they are the defender, they are the goalkeeper. So you can't have a soccer team with like 11 defender and then you are not doing any kind of attacking, okay? The next trade we choose to exit or enter depend on the state of your current portfolio. So a trade do not exist in a vacuum. They exist as an integral part of the entire portfolio. And this is one of the reasons why it is very hard for me to answer to a retail trader when they ask questions like, can enter this or not? Can I buy this or not? And the question and the thing is, I don't know. I don't know what your portfolio is right now. I don't know what's the state of your portfolio. I can't make that recommendation unless you give me full access to your portfolio, your risk appetite, your entire like financial like life lah. So as such, we must appraise floating profit and loss, and we do so at a portfolio level. So what we do is, when we look at our trades, we look at it at a portfolio level. Is the overall portfolio going up? If it is going up, then it's fine. I don't really care about which individual trade is losing money, which is gaining profit. But as long as the overall portfolio is up, the portfolio is doing its job. And then I will assess once certain trade hit their stop loss, I will cut them off, then let the winner run, add on to the winner, and that is how you compound your profit. And that's how we get so much profit from axometry. And this is the first of many differences between a professional trader and a clueless retailer. Retailer always very focused on the trade, that one trade. Like this one can enter or not, that one can enter or not, but they don't look at it at a much higher level. So the proper institutional term is actually portfolio managers. So if you look at a lot of like pop culture, like currently Netflix, a lot of shows about Wall Street lah, hedge funds lah, and in those shows, right, if you notice, they rarely use the word traders, but they will use the word portfolio managers, and this is the actual terms. There are a lot of portfolio managers. If you are trading in a hedge fund, you are basically a portfolio manager. You are not a trader. So terms like scalper lah, swing trader, day trader, wave trader, chart pattern trader, whatever terms are, okay, these are actually terms invented for the retail world for marketing purpose. And at a professional institutional level, right, there's no such thing. So if you one day get an interview at a JP Morgan and then they ask you what strategy you use and you tell them that you're a swing trader, you'll probably get asked to leave on the spot now, okay? So never tell them that you are a swing trader. You tell them you use long short strategy. Okay, so depending on the state of the market cycle, right, we also need to take a look at macroeconomic drivers, and we can shift our portfolio to slightly beta positive, slightly beta negative, like adjusting the volume on your speaker, high volatility, low volatility. We have a lot of control over our portfolio if you change your mindset to portfolio management rather than thinking of what stock to trade. So a long short portfolio strategy does not necessarily mean you must have 4 long, 4 short. The portfolio manager can adjust the portfolio bias to 5 long, 3 shorts, 5 short, 3 longs, depending on what the bias is. However, there must be a combination of long and short. You cannot have full long or full short portfolios. So the degree of the biasness, whether you are a bear or a bull, of the portfolio will be dependent on macroeconomic drivers. So understanding what is the data that is driving the current macroeconomy is also very important. So as we do not trade index, right? We never ever trade index. We can actually express our degree of bearishness or bullishness as per our portfolio beta level. So I can be my portfolio beta can be 0.1, 0.2, 0.3, 0.4. That will dictate the bullishness of my portfolio. Or if I'm bearish, it can be negative 0.1, negative 0.2. But if you are trading index, you are trading the market. So your beta is either 1 or negative 1. You are either long the market or short the market, and there's no way to express any kind of biasness in your portfolio management. So our portfolio is never binary. We are never full long or full short. We are neither bull nor bear. We make profit in all market. So this is your credit cycle, your current macroeconomic cycle. I'm not going to go through this in detail, but based on which stage of the cycle we are in, we will adjust our portfolio to either a neutral portfolio, net long portfolio, or a net short portfolio. So this is our trading framework. Basically, we will try to take a look at the macroeconomic to see what kind of portfolio bias we should adopt by looking at what stage of the credit cycle we are in. And then we will do a lot of bottom-up fundamental analysis in order to pick our stock. So the stock picking is at the fundamental level, okay? We do not use technical to pick our stock. We do not enter a trade because it bounced from the support or it break out of the resistance. No, we actually pick our stock based on fundamental. And technical is there for timing only, for timing purposes. By the time we look at the chart, we already know we want to take this trade. The technical give us whether or not we can enter. If we cannot enter, then we wait. It will sit on our watch list. And then we have our trade implementation, basically trade structuring, risk management. So you decide whether you want to go for a stock position or a option position. If you are going for option position, what are you doing? Are you doing a butterfly, vertical, calendar, iron condor, whatever lah. Okay, we need to appraise our trade structure to see what kind of risk reward ratio we are getting. And then of course we have our portfolio management. Once the trade is being added to our portfolio, we need to manage it at a portfolio level to see if it is going to shift the portfolio beta, if it is going to push our portfolio to a overexposed level, whatever lah. Okay. So documentation. So when I say you need to document your trade idea, right? This is an example of a documentation. So this is a report on toast. So I will be sharing this report with you guys as a freebie lah, okay? As a freebie on what is like being done in a professional environment. You don't simply suka see the chart for 5 minutes and then enter the trade. We actually have a very long due diligence process. And you can see these are all my files for all the trade ideas I have. I have all the earning transcript, all the thank you, 10K yearly report, whatever lah, okay? And some of the trade may made it, some of the trade will just die at the research level because I realized that, okay, this one sucks, I can't even enter this, or the fundamental not in my direction or whatever lah. Okay, so finally, we are going to 2026, what to expect for potential trading opportunity. Okay, K-shaped economy. A quick show of hand. Who know what is a K-shaped economy? Who have heard of it before? 来, show of hand. No one? Okay, I'm not gonna wait for response because if not we'll be here forever lah. Okay, so a K-shaped economy is what we are actually facing right now, post COVID-19. So it is a combination of COVID supply chain issue and all the inflationary pressure that's going up, and then we have the massive rate hike, and then now we are in the easing cycle, and then we have all the AI nonsense coming in, and this bring about this K-shape in terms of the economy. So after COVID-19, right, and the huge rate hike cycle, not every sector actually recover. If for those who are in my inner circle, you probably know that almost every month the manufacturing sector is in a recession now. Okay, every month manufacturing sector is contracting, but the service sector is actually doing well. So in fact, a lot of people are saying there's recession, blah blah blah. They are not wrong. In fact, a certain part of the economy is actually in a recession, but there are some part that is actually doing very very well. So what you have is those sectors that are doing well, they are doing exceptionally well. They are having the best time of their life. Those that are in the material sector, the AI sector, semiconductor sector, whatever lah, okay. And those that are in the lower arm of the K, which is basically travel, entertainment, hospitality, food services, anything to do with consumer spending, anything that is dependent on consumer spending, right, is actually not doing that great because a lot of consumers, in especially in the US, they are the sentiment is very bad lah, okay. The inflation is very high, their rent is very high, the mortgage is very high, they don't have enough money, they are behind on credit card debt, and they even have to use buy now pay later to pay for grocery, that kind of stuff lah, okay. So there's very little discretionary spending going on, and that result in a lot of the discretionary sector not doing that great. But all the AI, all the engineers, software engineers, all the AI data scientists, all this, they are doing very, very well. Okay. So we have what we will call the K-shaped economy. So in 2026, we have the K-shaped economy. So the question is, of course, whether this K-shaped economy will persist or will it start to break. So the upper arm of the K, which are the winners, these are the key sectors that are involved. The big tech, AI, semiconductor, no surprise lah. Defense and aerospace, Trump just announced 1.5 trillion spending in defense. So you see a lot of defense stock going up lately. Energy, oil, gas, and uranium. So the reason why energy is doing very well right now is mainly because of all the energy requirement for AI data center. Okay, so when I say energy, right, I'm not talking about all the oil drilling company. I'm actually talking about those utilities company that is providing the actual energy, like all the nuclear power plant, like Constellation Energy, those kind of stuff, Bloom Energy, industrial with pricing power, capital light platform, luxury goods. So in the discretionary area, yes, luxury goods are actually doing very well. Because the rich are getting richer. Okay, there's a very big disparity between the upper class and the middle class, and the financial, the finance companies are also very doing well. So what are the macro drivers that sort of bring about all these winners? High interest rate. So now high interest rate. What I mean here is that it's not that these companies like high interest rate. Nobody like high interest rate. But the thing is, high interest rate actually kill off all the weaker firms. And only those with very strong capital, very strong cash flow and balance sheets can do well in this kind of high rate environment. Okay. Currently, we are sitting at 3.5% interest rate, and that is still high compared to where we were during post-COVID at 0%. And in fact, if you are around my age, we actually lived through almost our entire life at 0% interest rate after the 2008 housing crisis. So this current interest rate regime, right, is very, very new to us. Okay, it's like an uncharted water for those who are within my generation. AI and automation capex. So there's a lot of capex spending from Meta. OpenAI is spending like crazy, even though they don't have the money. And then we have government deficit and defense budget. These are not cyclical demand. And we have the energy under investment. So all the energy that's available in US right now is actually not sufficient to power all the AI data center. Okay, in fact, in certain area, they are facing blackout and they actually have to sort of ration the energy. And in fact, companies like Meta and Google, right, they are buying contract to have dedicated grid supply, and that is how much power they are using. And then we have the lower arm of the K, the loser sector, consumer staple. So as I mentioned just now, right, you can see from the 2025 also, the consumer staple is the worst performing sector for the year. Discount retail, traditional retail, apparel, Nike don't know drop until where, Lululemon don't know drop until where, restaurant, so you Shake Shack don't know drop until where recently. Shake Shack just recover okay, but prior to that it was very, very low. Small mid-sized businesses, so a lot of small medium-sized businesses are actually doing very bad in US. Labor intensive service, commercial real estate, all these are not doing that great. So some of the macro drivers, sticky inflation, because inflation high means less discretionary spending. Okay, high borrowing costs. So with interest rate at 3.5%, right, the borrowing cost is very high. Okay, so a lot of people, they cannot buy their own home, they have to rent, and when they are renting, right, they actually they are subjected to this very high rental payment. Okay, housing services, wage pressure, consumer trading down, volume declining, credit tightening, low productivity growth, and margin compression. So these are all causing the lower arm of the K to underperform. So what can actually break the K-shaped economy? Aggressive and sustained monetary easing, meaning we need to have more rate cuts, more than what is being projected. We need lower credit spread, job market improving versus inflation. So this will result in improving consumer sentiment. We need unemployment rate to go down so that people are employed and they can spend money. And we also need some decline in inflation. Fiscal redistribution to lower arm, meaning we need some form of support from government as well, mainly coming in the form of tariff relief. Okay, so all this tariff is causing a lot of inflationary pressure on like common goods, services, and goods. Okay, capex slowdown in the upper arm. So maybe those companies in the upper arm like OpenAI, they stop spending so much. Okay, then perhaps the funds can kind of rotate, the market can rotate the funds into those sectors in the lower arm. Consumer sentiment improve, funds allocation shift from upper arm to lower arm. Okay, so now with that said, right, how is the current job market situation like? In fact, it's not doing that great. So job growth is very weak. In fact, the most recent NFP data is one of the weakest data since COVID-19, not improving materially. Growth is below trend. Unemployment currently sitting at 4.4%, slightly elevated, okay? But it is not so high, but definitely higher than what we have been used to in the past. In the past, it was like 4.0%, 4.1%, but now it's at 4.4%. Wage growth is positive, but it's kind of like slightly positive only. So it's not really kind of like promoting any kind of discretionary spending. The layoff is low, but the hiring is also low. So we are in kind of like a gridlock, okay? Participating sector and strength is mixed, uneven improvement. So in the US, right, the current job market situation is what we call low hire, low fire, okay? There's not a lot of firing happening right now, but there's also not a lot of hiring. So if you are unemployed, right, it's very hard to get hired. But I mean, if you have a job, then highly likely you may not get fired. So more improvement is actually needed in order for the overall market to improve and for the overall K-shape, the lower arm of the K-shape to kind of like recover. So interest rate. So what is the current interest rate? Right now we are at 3.5%, and the 3.5 to 3.75%, and the expectation for 2026 is 3.4. So we only have projected of one rate cut, 125 basis point rate cut coming in, and that is not sufficient for the lower arm of the K-shape to recover, okay? And the unemployment rate, the expectation is at 4.4%, which is the current rate right now. And you can see the PCE inflation is projected at 2.4. So what I can deduce from this is that Federal Reserve want to hold the interest rate at 3.4. They will only do one rate cut, and hopefully they can maintain this unemployment level until the inflation goes down to 2.4%. Okay, and in 2027, right, they are actually projecting 2.1%. And if they want to hit 2.1% PC inflation, right, I think they will deliberately keep the unemployment at this level, okay, in order for inflation to go down. If people don't have job, then they have no money to spend, okay, so there's no inflation. But of course, tariff also kind of muddle the whole inflation and interest rate relationship. So inflation, PCE currently sitting at 2.8. Federal Reserve expectation at 2.4, though if they want to bring it down all the way to 2.4, right, it's gonna be a little bit hard, okay? It's a little bit hard. This is actually September's reading, mainly because of the government shutdown. We don't really have October, December yet, okay? So this is PCE, not CPI, okay? CPI data is out, but the Federal Reserve like to look at the PCE level. So what to expect? So we now have a good idea of what is going on and overall macroeconomic view, right? It is important because it anchors us to a specific bias, and we know what to look out for. We know what to do. We know what kind of stock you want to find, and it gives us a direction, okay? If you go into trading without any biasness or any knowledge of what the current macroeconomic environment is, you won't know what to look out for. You will be at the mercy of whatever other people are sharing. Like other people share something, you will be like, oh, okay, I'm gonna enter this, but you have no idea what's going on. So what to expect? So currently the status quo, okay, the status quo is for the K-shaped economy to continue as it is until consumer spending and sentiment improve. The latest TSMC result shows the demand for AI and data center, they are still high. So on the contrary to what a lot of other people are saying, AI is not a bubble. Okay, AI is not a bubble. There are money going in, and yes, a lot of people say the money is going in circle from OpenAI to Nvidia to whatever, but there are actually a lot of external money going in, and there's also a lot of end use lah. Okay, end use for AI. So, is it overvalued? Yes, it is overvalued, but it is overvalued for a reason, because the growth expectation is very high. Is it a bubble? No, it is not a bubble. So when something is overvalued, there is a risk of deleveraging, meaning you will probably see some kind of a correction in the AI sector in 2026, where maybe Nvidia may go down 10%, 12%, but that is a correction. That is not a bubble bursting. A bubble bursting will mean Nvidia will fall like 80% all the way back to like, excuse me, all the way back to like $100 level like that. And that is not going to happen, okay? Because the capex, the spending in the AI sector is very high. There is a lot of money there. And those money are going around, okay? So maintain some exposure in AI data center stock. So you will still want some data center stock in your portfolio as long position, but the important thing is, of course, don't go all in, okay? Don't have your entire portfolio in the AI data center space. Don't go for familiar names that are already overstretched in terms of valuation, meaning don't go for Nvidia, don't go for Applied Material, don't go for Micron. Those are already stretched beyond don't know where already. Go for the laggers and lesser known names because those probably still have room to move. And as I mentioned, right, if you know how to look, there's actually a lot of potential in the US market. Have some trades to prepare for a potential recovery in the lower arm of the K. So you do not want everything to be in the AI data center. You will want some stocks that are in the lower arm of the K, the sectors that is in lower arm of the K, some of the consumer discretionary stock. Okay, because if the K-shaped economy kind of breaks and if the lower arms start to recover, right, those stock don't know drop until where already, and you're gonna get a very good profit out of it in terms of risk reward ratio, okay, compared to chasing all the AI stock that's already at the high. So you will want to have some exposure in those. Cover all scenario. You want to cover all scenarios. So like I said again, you have the K-shaped economy. So you want some long position here in case the condition persists, but you also want to have some short position here in case the K breakdown. Same thing, in case of potential recovery, you will want some long position here. And in case the status quo persists, you want some short position here also. Okay, so you want long short on the top, long short on the bottom. And then you have covered all scenario. You can sleep in peace at night because you don't really care where the market is heading. Had some short in overstretched data center stock as a hedge for hedging purpose. Had some shorts in consumer stock in case K-shaped economy persists. Cover all scenario, okay? And you will make money regardless of whatever happened to the market. So market may not move in a broad-based manner for 2026, meaning we will hardly see a scenario where the entire market is green, everything is green, that doesn't matter what sector you are in. It will be more selective. So I believe 2026 is the year where stock selection will be rewarded very handsomely, okay, compared to say just trading the index itself. So even in AI data center play, right, choose your stock wisely because there are a lot that haven't rallied yet or that have a lot of room to rally now, okay? So now finally we are at the potential theme and potential trade. So let's go through them. So this is axometry, just to share with you again. It was shared last year in a webinar like this. It is a public webinar. It was around July. And when I shared this, axometry was like what, $30? Currently it's sitting at like 100 and something, right? Anyway, obligatory, sorry, obligatory disclaimer. Obligatory disclaimer. Not financial advice, blah, blah, blah. You all know lah, okay? So these are trades that we have on our watch list and we are looking to enter. So the trades that we are sharing is the trades that we want to enter or I want to enter. It's not I'm asking you to enter. It's not, okay? So if you are going to enter because you think I make sense, then by all means, but this is not like, hey, you enter that. None of that, okay? Our trades are backed by many hours of research, but this does not mean that you should enter everything when market open. Okay, later, don't 10:30 like you exit the webinar and then you go and enter all the stock that are being mentioned here. Please don't do that. Depending on macro development, we may or may not enter the trades that were shared here. So we are just sharing the trades here that we believe have good potential, but if things change, we may not even enter at all. We are not obligated to provide updates or entertain message like, bro, you still holding or not? Bro, you cut already or not? Bro, can enter or not? Bro, can chase or not? Okay, so please do your own due diligence on timing, risk, and exit strategy. On a more serious note, the reason we cannot give advice is because we don't know your risk appetite. We don't know what you have in your portfolio. We don't know what kind of position are you trying to enter, option, what option structure, stock position, how many lot sizing. We don't know, so we cannot give an advice that is like doesn't sort of cover all bases lah. Okay, and at the same time, right, if 40-50 of you are asking me, right, then what I have to answer everybody really, like I cannot play favorite like that. Okay, so just do me a favor and please do your own due diligence on timing, risk, and exit strategy. Profit level provided are guidance, not fixed level. We may exit early or later. We prioritize portfolio management instead of individual trade. Trade decisions depend heavily on what is in our current portfolio and how they are performing. If you only pick and choose long position and then you ignore all the short position, then you're not running the same strategy as us, and then some of the trade may not work for you. We may take complex option and hedging position to offset the risk. Our portfolio makeup timing updates are reserved for our course graduates and inner circle members. Okay, team number one, is it AI though? Coverage. So this is for the upper arm. So we want to cover the upper arm long position. So now AI. Okay, now let's do a game. Let's do a fun game. Okay. So I have a bunch of companies here. I have hide the name. So these are the performance for 2025. Okay. For the entire of 2025, this is the movement. So these are all AI data center semiconductor related stocks lah. Okay. Nvidia is in there, Google is in there, Meta is in there, and a bunch of other stuff lah. Okay. So now, who know what is the one at 1000% gain? If you can tell me this correctly, right, I will give you $250 voucher for my course. The upcoming batch. TSMC. Good guess, but no. Come, I'll give you guys 3 minutes. Palantir? No, not Palantir. No, not Palantir. Good guess, but no. I don't think Palantir gained 1000% in 2020. Let me do a quick check. Let me do a quick check. But it's not Palantir. Palantir is not inside here. ASML, no. SNDK, no. Nvidia confirm no lah. Nvidia confirm no. Palantir this year only 100%, 125%. Yeah. I mean 2025. It's not Palantir. Not Nvidia. Okay, this one no reward. Who do you think is at the bottom? Who is the worst performing one? This one. Who is the worst performing one? Oh, wait, somebody got it right. Wait. Somebody got it right. Somebody got it right. But the person has no name. The person got one fish. Scan this. Someone said earlier. Whoever said earlier, the one with the fish. Is it a fish? I don't know what is that. Please message me. Please private message me. Give me your email. If you happen to come for our course, I'll give you $250 discount. Finding Nemo. Finding Nemo. Private message me, okay? Okay, so the one at 1000%. Okay, I'm just gonna review lah, okay? Here, scan this at 1036%. Who still remembers scan this? Those little cards that you put in your camera. And the worst performing one is Meta at the top. The second best is Western Digital Corporation. And then the third is Seagate at 250%. Sorry, not Seagate. Micron at 251%. And Seagate is at 215%. Okay, and The one that is not really performing that well is actually Microsoft, Meta. Where's Nvidia? Oh, I don't even have Nvidia here. But Nvidia is not really doing that great, lah. Okay, I mean it is positive, but it's not as great as all the stuff that you are seeing here. And at the mid level, right, we have stocks like Credo, we have stocks like Google, ASML, AMKR. So scan this. The top performer, it is because the NAND pricing bottom and AI server need more SSD per box, creating sharp operating leverage of a cycle trough. And then you have Seagate's technology coming in at fourth place, 215%. AI data center explosion revived nearline HDD demand just as disciplined duopoly restored pricing power. And then we have Micron Technology coming in at 251%, third place. HBM is high bandwidth memory, scarcity and DRAM price recovery flip Micron from losses to supernormal margin and triggering a structural re-rating. Western Digital, WDC, second place, 335%. The stock re-rated as both NAND and HDD pricing recovered simultaneously, giving WDC a rare dual cycle leverage. So you can see all the theme that's happening here is actually all the memory storage. Okay. So what I'm trying to tell you here is that even within the AI space, the data center space, right, there is subsectors that are outperforming compared to the rest. You have downstream companies like Nvidia, AMD, and then you have all the software, all the service company like Google, Microsoft, and then you have all the materials companies like okay, I don't really have any material. Okay, AMKI is a material company, and then you have energy company to power the energy requirements such as Oklo, which is nuclear, is in the nuclear energy sector. Okay, so the AI data center space is very big. You don't always have to go for the same name because there are certain areas, certain part of the sector that is severely overpriced, and there are certain areas that are very underpriced. Okay, so if you know where to look, right, if you know what is the ongoing theme, you can actually place a very good position in certain stocks, or you can go and find certain stocks and you get rewarded handsomely for it. So now with that said, theme number one, high bandwidth memory shortage, HBM shortage. So I'm sure you guys seen all this all over Facebook. AI memory sold out, Nvidia faces HBM shortage, SK Hynix to spend 13 billion on world largest HBM memory assembly, blah 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 blah. You have this ongoing, okay? So now first stock, Entegis, ENTG. Who heard of ENTG before? Oh, what's going on here? Okay, so basically what does ENTG do? They supply critical material and purity solution like CMP slurries, advanced filtration, deposition materials used in advanced semiconductor manufacturing, especially in the AI logic and HBM. So I'm not really, okay, I mean, I'm not expert in this whole area, okay, but basically, the wafers, the production of the wafers and the HBM, right, they need to be very clean, like not even 1 micron particle can be on the wafer itself, and the wafer itself have to be like very flat, like flat in terms of like molecular level, okay, and in order to do all this, right, they need a lot of this purity solution and all these CMP slurries, okay. So what ENTG does is it provide all these chemical, all these materials. So utilization upside. So ENTG have a Taiwan and Colorado fabrication plant that is underutilized. They are waiting for their client to finish their qualification. So only once the qualification is finished, right, then they can ramp up the production. Okay. So they are currently in like that the lull phase where the facility is there but it's not doing anything. It can't do anything yet. So it's just sitting there wasting money, okay, eating into the expenses. But once the volume ramp begins in 2026, right, it's gonna drive a lot of operating leverages in. CapEx peak have passed. meaning all the capex spending is over. Heavy investment cycle is largely complete, so they are now waiting for lifting of the free cash flow and the margin. So AI content growth, though, so the HBM, excuse me. So the HBM, the CMP consumable liquid filtration, they are growing very fast, and content per wafer rising at advanced nodes. Margin recovery. So the current margin pressure is currently they are facing margin pressure because of the two facility in Taiwan and Colorado that are still sitting there not doing anything. Okay, but it is actually part of the process also, part of the process in a sense that they need to wait for the client qualification to finish, then they can start the production. Okay, so it's actually part of the process. So it's not that there's no demand or the demand is softening or whatever. The risk is that the AI content demand soften. Okay, so this is your upper arm of the K-shaped breaking. So now, my profit target is $150 at first level, 175 at second level. But you can see the stock has already gone up quite substantially. So you may want to scale your entry in slowly and ensure you have the bullet to buy the dip also. So ensure you have the holding power. Okay, definitely if it start to dip, right, and you are trying to buy the dip, you need to hold for a much longer period. Team number two, who's going to use all the AI? So this is also a coverage for upper arm, long position. So we are trying to get ourselves continue exposure in the what do you call that, in the AI space. Team number two, Symbiotic, SYM. So what Symbiotic does? Design and install fully automated warehouse system for large retailers, combines robotic software and material handling to automate pallet storage, picking, and sequencing. Focus on high throughput distributions, center scale operation, not the small warehouses. Customer include large cost sensitive retailers seeking labor reduction and efficiency gain. So they don't really reveal who their customers are, but they call them the blue chip customers. So I'm guessing people like Amazon. Okay. Symbiotic, the buy thesis. They have 22.5 billion contract in the backlog with blue chip customer, provide multi-year revenue visibility and underwrite growth. The next gen system are shortening the deployment and driving margin expansion. So basically their project is very big. Okay, so once they land a customer and they start deploying all their fully automated system, right? It's not like the customer order today and then tomorrow the system is in place really. It's not like that also. It's gonna take like a multi-year of trying to qualify the system and putting them in place. So the gap between landing the customer and completing the project is very long. And only when certain milestones are hit, right, then they get the money. So in order to get more money, in order to like get the money faster, right, what they need to do is they need to deploy their system faster. They need to deliver the system faster to their customer. So it is like you queuing up at the Yishun 925 laksa. People drive all the way from Punggol come here eat the laksa. I cannot understand also. I personally ate the laksa, but it sucks okay. I mean, it's not that it sucks, it's like not worth the drive. But anyway, like you queue there for like 3 hours, but the auntie slowly pouring the laksa, so they are not going to make a lot of money. But if the auntie spend like 10 seconds on one customer, right, then she can earn more money in the same time frame. Okay, so this is actually a catalyst because Symbiotic is actually shortening the deployment cycle and they are delivering the project faster to their customer. So it will push the business into sustained positive EBITDA and free cash flow, expansion into micro fulfillment, healthcare, and there's a green box joint venture. It's actually a warehouse space that is waiting for customers. Okay, it's waiting for client, and apparently there are a lot of people interested in green box, and they are picking out who is the highest bidder or something like that. So for Symbiotic, you can see it kind of like have a very nice uptrend here. Going down a little bit, but maybe you can take advantage of this I don't know, this small little retracement for higher for entry lah. Potential target at 100 and second target 120. So I'm not going to give you all the timeline and all the stuff lah. Okay, so you go and work that out yourself. Thing number 3, burnt toast still tastes good. So this is coverage for the lower arm of the K-shape, long position. So we are covering the long first, okay? So this is toast. I have shared toast on Facebook for quite some time already, but I mean after I share, it's still coming down. Okay, so not every trade today share, tomorrow go up. Okay, you need to wait for the opportune moment to go in. So what does toast do? It's an all-in-one cloud price of sale payment system, software platforming, powering restaurant operation from ordering, payment, payroll, menu service, whatever. Okay. The buy thesis, sticky ecosystem. Once the restaurant onboard toast, the switching costs are very high. Okay, so once they get a customer, most likely the customer is going to be there. Recurring monetization, grow revenue per location via payment volume and add-on software modules. Margin inflection, mix shifting away from hardware towards higher margin software and fintech gross profit. Long runway, restaurant type penetration is still low with expansion into enterprise and international market. So they are going into international market. Okay, and they got a lot of popular name that have toll system running in the US. So in this case, it's currently downtrend. It is still downtrend right now. So what you probably want to do is, in this case, the technical analysis will be a very helpful timing indicator. Okay, you will probably want some form of momentum improvement before you actually goes in. So you don't want to buy into a declining stock, okay? Even though the fundamental is there, right, you wait for the technical to give you a green light. Theme number 4, strong studio soft sale. This is coverage on the lower arm, but we are shorting this. So this is for a situation where the K-shaped economy still persists, the lower arm getting back to worse. Lionsgate. Lionsgate is the movie maker lah. Okay. Lionsgate, what it does: film and TV studio, monetizing theatrical release, TV production, large content library across licensing and distribution. The short thesis here. So the most recent earnings, the revenue is actually under pressure. It actually fell by 21%. Driven by fewer release, softer delivery, timing, highlighting volatility in the core earning power, but nonetheless, the stock kind of like went up 30%. Okay, so the idea here is that this rally here is not justified. I feel like, okay, I feel this rally here is not justified, and because the current economy, right, as I've said, we have a lot of weakness in consumer spending. Maybe people might stop going to the movie theater, and even for streaming services, right? There's a lot of streaming services right now, so they are kind of like consolidating already. Maybe a lot of people, they may only keep one streaming service, and maybe they are not keep buying all the streaming service available. So that will eventually like put weakness into Lionsgate. Weak consumer backdrop, box office attendance, discretionary spend remain fragile, amplifying downside risks to theatrical performance and downstream monetization. Earnings still negative, operating at a loss of $46 million and an adjusted net loss of 20 cents per share. So they are not making profit, they are actually losing money. And they're actually burning cash. Okay. So the leverage, they actually increased their debt. The net debt went up to 1.7 billion, which is now sitting at 6.4 times leverage of operating income. So that's a very high gearing. Okay, so they are actually the balance sheet is not really that great. And in this kind of market environment, right, weakness in balance sheet get punished very hard. Thing number 5, growthless monopoly. This is coverage for upper arm, but it is a short position. So VeriSign, VRSN. VeriSign, what it does, it operates .com and .net domain registry, earning recurring revenue from domain registration and renewal under long-term contract with ICANN and US government. So when you go on to website like GoDaddy or Wix, and then you want to make your own website and you have to buy the website domain, right? What GoDaddy or Wix does is they are actually the middleman. They actually buy from VeriSign, especially those with .com and .net, and then they sell it to you as a premium within whatever package that they are trying to sell you. Okay. So VeriSign actually is a monopoly on internet infrastructure, especially in the .com and .net domain. So what is the short thesis here? The short thesis, oh sorry, but the chart is wrong. My bad. The chart is wrong. Sorry, let me put the correct chart. Whoops. Sorry, give me a second. Okay, okay, sorry. This is VeriSign. Okay, so it's basically a very boring business. So the growth ceiling already reached. The .com net ads have stopped as domain saturation rises. New business formation slows. So now there are a lot more domain ready like .io, .info, a lot of stuff lah. Capping volume-driven growth despite pricing power, margin under pressure, operating margin face structural compression from rising security, infrastructure, and compliance costs, eroding the historical perfect monopoly narrative. Premium valuation at risk. The stock trade at defensive high multiple valuation despite low single-digit revenue growth, making it vulnerable to multiple derating as growth normalize. Buyback mask fundamentals, so they do a lot of buyback because for a company like this, right, where there's not much room to grow already, not much area to innovate, what they do share buyback law. But this buyback actually kind of masks the EPS growth lah. Okay, so a lot of the EPS growth, which is already very bad, is driven by the share buyback. So sometimes share buyback, just because a company is doing share buyback, right, is not always that great. For example, Dropbox have been doing very aggressive share buyback, but the stock keep falling and falling because the business is not growing. That they are not, unless they take very huge risks and go into certain sector that they are not familiar with, or they just want to take a risk. If not, they have nothing else to do but to do share buyback. Rate sensitivity, higher for longer rates weaken the appeal of long duration, slow growth cash flow, pressuring valuation for defensive monopoly like VeriSign. So you can see here the stock already dived one time, and this is what we call X growth chart lah. Okay, so they will do a first dive, and this first dive, a lot of people will think like, oh, just retrace, but after what happened is they will do a second dive, and this is where people will start to realize that okay, this is definitely fundamental in play really. It's not just a technical retracement or whatever lah. Okay, so if you are a wave trader, this is typically your 1 2 3 wave lah. Okay, sorry, not 1 2 3 wave, 1 2 3 4 5 wave, where your wave 3 is actually the biggest. Your wave 3 is the biggest, so this is actually the wave, incoming wave 3. Last one. But airport can auto translate. This is coverage for lower arm long position. And this is actually a very high risk trade. High risk but high reward. Okay. So sometimes within a portfolio, right, I like to put one trade that is like very high risk, but because it's very high risk, right, I will not play a very big position. I will play a very small position, but if that small position pays off, right, the payout is very, very big. Okay. So the risk reward ratio is very high, but the chances of you winning that trade is a little bit low lah. But nonetheless, if you have the catalyst, if you have the fundamental behind it, then why not? Why not put in $1,000? If that $1,000 become $10,000, then I mean you also happy lah. Okay, so Duolingo. Duolingo has been getting like hammered very, very bad. Even currently I'm looking at my market right now on my other screen, and it's like very bad. It's like superbly bad. Currently at $149. Okay, so Duolingo, a consumer education platform monetizing language learning and expanding vertical in math, music literacy, and high margin English proficiency tests, primarily via subscriptions. The buy thesis here, re-accelerating growth. Okay, so now the reason why Duolingo is dropping, right, is very funny. Is mainly because it's not that they are growing. They are still. It's not that they stop growing. It's that they are still growing, but the growth kind of like slow down a little bit. The growth kind of slow down a little bit, and maybe it's like they are initially they are growing at 34%, and then in their latest earning they are growing at like 32%, and then but they are still growing 32%, but because of this slowdown in growth, right? Suddenly the market panic. But on top of that, right? Duolingo is they mentioned that they are actually investing a lot of money into AI related stuff in other area aside from language learning, okay? And because of that, it affects their margin, affects their cash flow near term. But in the long term, I do believe that they will have all this additional money coming from all the additional product that they can provide. And the issue here is that if your product is just language learning, then definitely you are at a very big risk, like the airport coming out with auto translation, all this, right? Then definitely your product will be at a very big risk. So I would think that it is the right decision to spend money in order to do your R&D and provide more services to expand beyond the language learning, so that you are not made obsolete by Apple iPod or whatever other translating material, AI translation that is out there. So I think the fact that they are doing this is a positive, but the market is kind of like punishing them for it. Like, why are you spending so much money? Why is the growth decelerating? Blah blah blah. And they were punished very hard. They were punished very, very hard. In fact, from the top of like $500 plus, right? It is sitting somewhere around like $140, $150 like that. Okay, so you can see here, I put the support level at $150, which is previously the 2024 July level, but currently, as I'm looking at the market right now, it is at $149. It already dipped below the support, okay? But we see whether or not it can like climb back up. So margin expansion underway, operating leverage is kicking in as content scale digitally, market efficiency improve, and incremental revenue carry high contribution margin. So it is not that they are losing money, also their cash flow is actually very strong. They have extremely high cash flow. Multiple growth factor, expansion beyond language, so like math, music, literacy, and continued growth in terms of English tests, diversify revenue, and extend Duolingo long-term TAM. Pricing power with low churn, subscription prices increase, and premium tier have been absorbed with minimal churn, reinforcing the strength of the brand and habit forming engagement. And their monthly users are still growing also, so it's not like they are losing users. High quality cash flow profile, strong free cash flow generation with a capital light model, support reinvestment, optionality, and valuation durability. So valuation reset entry. So because of this very crazy pullback that we are seeing here, it compressed multiple while majority of the fundamentals still remain intact. Okay, and I do feel that this is definitely overdone. And once we see some sign of like a technical recovery, right? I do think that you can put a little bit inside. I mean, you don't need to put a very big position. Maybe if you normally risk like $1,000, maybe you can risk $500 for this. And I do think that if it recover, it can minimally close the gap at 265 lah. Okay, obviously it's not going to go back to $500. unless whatever new stuff that they have invested or put their R&D on started showing abnormal amount of growth. If that happened, then maybe it can break 500, 600. But for now, as it is at a conservative level, right? I think 265 is not asking too much. Not asking too much lah. Okay. Okay, so that is all the trades that currently we have spotted. So like I said, right, don't go in immediately. That's not the plan. Of course we need to wait for right timing. We need to wait for what your portfolio need or whatever lah. Okay, do some due diligence. Go and look at all these company by yourself and come to your own decisions lah. Okay, so engaging with us. So this is the way you can engage with us. I will send this in the chat. So later you go see your chat, I will upload a Word document with all this info lah. Okay, so you can come to our Discord channel, basically free. Access to public channel, engage with the team, update on upcoming events. So webinar like this, if we do again in the future, right, is usually announced on our Discord channel lah. Okay, and once in a while you will get free occasional analysis lah. Okay, let me just show you the Discord channel. This is our Discord channel right now. Here, so if you join, you have access to the public area lah. Okay, so within the public area, you can see I provided some free trade report. There's Alcoa there, there's Shark Ninja there, and today webinar is here. You can like I will put some update here, whatever lah. Okay, and the rest are our private channel for our inner circle lah. Okay. And our Patreon is a monthly service, something like Netflix like that. So what you do is you get weekly webinar, you get access to our trade ideas, trade setup, our private Discord channel. And then we have our course, trading course. So if you want to learn how to find stocks like Axometry, Credo, all these kind of stocks that you have like never heard before, you want to know the process behind uncovering them, right? Then you can come for our course. So we provide two kind of course. One is a trading course, which is the normal one. It's an online course lah. Okay, but the other one is a one-to-one mentorship where I will do a one-to-one with you. Of course, we need to fix a schedule lah. But if you are a very busy person, you got a lot of discretionary money to spend, right? Then maybe one-to-one might be good for you lah, because we will go into a lot of stuff that we don't normally do in trading course. We will be managing your portfolio full time. Okay, not I'm managing your portfolio, but I will teach you how to manage your portfolio full time so that you are able to learn how to become an independent trader lah. Okay. Then we have the Facebook group, which basically where you probably know this webinar from. And if you want to email me, you can email at zawoo@nimbuscapital.info. So I'm gonna send this into the chat and I will upload this on our Discord channel. Wait, give me a while. Okay. So stupid, it's currently in use. I can't send. Okay, so I'm also going to paste the Discord link for one very simple reason. So now where do you access this webinar PowerPoint and the recording? You can access it here under the public area. You go to 2026 Outlook Potential Play. I will actually upload the recording and the webinar here. Okay, so I'm going to get the link and I'm gonna copy paste there so you can access Discord from there. So now very important, Discord is not free from scammer. So if somebody with my name message you, right, that's not me. Okay, I will never message you. I will never private message anyone asking them for money, asking them to sign up for certain brokerage, asking them how they are doing. I will never do that. Okay, if I message you, that's not me. So please be diligent when you are on this kind of platform. And that, I mean that there's no way I can stop all these kind of nonsense, which is very annoying also. Okay, so we are opening up our trading course batch 11. So this website outdated lah, okay. Batch 10 finished already. Currently we are gonna open batch 11 in March this year, sometime after Chinese New Year. So if you are interested in coming for the course, you can go to our website, nimbuscapital.info, and go and take a look at all the information. Okay, so if you want to learn how to trade professionally, if you want to be independent, find your own trades, this course is definitely for you, because I'm going to teach you all the long short portfolio management, how to diversify properly, how you can trade like how the professional trade. Okay, none of those smart money indicator, all those nonsensical stuff. Okay, so if you are interested, you can come here, you can go and register. I haven't opened it officially yet, but you can register first. Eventually, when I open up the registration, right, I will definitely email you. Okay, so this is something that you can consider. So some advertisement as part of our course, right? So when we teach our course, during the course itself, what we will do is we will teach and show you how to screen, research, do a proper trade report documentation, and we will enter one live trade. Okay, every batch we will pick one stock and we will enter that stock. So far we have started that practice from batch 7 and all the way until batch 10. So we have 4 trades that we pick out in our course so far, and all the trades are doing exceptionally well. Okay, in batch 7 we actually pick out Palantir. That was when Palantir was at $6. So I think batch 7 was like 2023, like that. We only host 2 batch per year, sometimes only 1 batch per year, because it's very time consuming. So we actually spotted Palantir at $6. Currently it's sitting at $100, don't know where really. Batch 8, Carpenter Technology, you probably never heard of it before. Currently it's up about 427% since the day we spotted this. Batch 9, Alcoa, not only we spot this, right, we actually share it with the public for free, and it's up about 157%. And the latest one is Shark Ninja. Shark Ninja, unfortunately, the first entry lost money, but the second entry we managed to get in at the support level, and now we actually got about 50% gain from Shark Ninja. The Shark Ninja movement is about 50%. So who know what batch 11 will be? We will definitely see what is available when we start the course. Okay, so it is not just me spotting the trades. Also, a lot of trades are actually spotted by our course graduate. I have an analyst that is working under me who have gone through the same process. In fact, she spotted quite a number of trades also. For example, Crystal Biotech. The green box are long position. Crystal Biotech spotted by one of our graduates somewhere here. Credo was also spotted by our graduate, one time here and one time here. So basically a very big rally. SI time, Kratos was spotted very recently. The person spotted like right here, and then it went up. And then Dropbox is a short position. Dropbox was spotted sometime around here. And Shake Shack was actually very, very popular. It was spotted twice in 2 different years. The first one was spotted very recently. The latest one was spotted very recently. And prior to that, one person spotted like somewhere around here, okay, about 2 years ago. So we do have some of our graduate diligently sharing ideas. If you spot something that is potential, we will share among one another. Okay, so if you come for the course, definitely there's a lot of room to grow. There's a lot of post-course activities that you can do. You are unless you choose not to do them. Okay, if you choose not to engage, then there's nothing much we can do. But if you decide to be a part of the active trading community, right, then definitely there's a lot of room for you to grow and a lot of profit to be made. So if you are interested, go to our website, just drop me an email or whatever. Okay. We have come to the end of today's webinar. Just nice 2 hours. We are hitting 10:59. So I will open up the floor for Q&A 15 minutes. If I don't see any question within like 1 minute, then I consider there's no question now. Okay. So the floor is yours, guys. While you guys are waiting to ask, I'm gonna look at the market. You can type in the chat so that I can read it out. What will be a comfortable capital for beginner long short portfolio? Good question. Capitalization is very, very important because like in the professional scene, we will laugh at those people who want to open up $1,000 CFD account. Definitely not doable, lah. Okay. And especially if you are utilizing options, right? Definitely need a higher capital because option minimum contracts is 100 contracts. Sorry, one option contract is equivalent to 100 shares exposure. So sometimes certain contracts will cost you $1,000 and your risk is $1,000. So you need to have a very big portfolio size lah. So my recommendation is somewhere around $30,000 USD is a good start. You can get away with $20,000 USD, but it will be a little bit limited lah. Okay, so your capital is very important because it actually affect how you trade also. Imagine, right? Imagine you spend 2-3 hours to do all the necessary work, go and find a stock, research a stock, do your fundamental analysis. And by the time you put up the trade, right, you probably spend like 4-5 hours doing all the work. And the trade goes in your direction. And because your account is so small, right, you get 50% movement on the trade, but you are only profiting like $100. You spend 5-6 hours to profit $100 because your account is very small. I mean, I'm not looking down on $100, but if you look at per hour earning, right, you probably better off working at McDonald's lah. And that's not trying to look down whatever, but that kind of discourage you, it kind of demotivate you to put in the effort. And that is where a lot of retail trader turns to copy trading. They don't want to put in the effort because if they put in the effort, the profit is not worth it. So they might as well just copy trade whoever already put in the effort lah. And that result in not doing due diligence, no idea what's going on, no knowledge of the trade thesis, don't know what is the catalyst, and then every day asking can exit or not, can hold or not, those kind of stuff lah. So the importance of your portfolio to be properly capitalized is not only from a risk management perspective, but also from a psychological perspective where when you put in effort and you profit, right? You want to, feel good. You want to feel really good. You get like a few $1,000 out of it. And in order to do that, right, you probably need like a 30K, 40K, 50K account so that you will be probably compensated fairly for your time. Uh, is Chevron is good buy right now? Okay, I'm so sorry. I forgot to put a disclaimer. Please don't ask me this one can buy or not, that one can buy or not. Because like I said, in order for me to determine if something can buy or not, we will actually do a very thorough report. We will do a very thorough research. I cannot do a thorough research in a space of like 10 seconds right now. Okay. And if you ask somebody whether something can buy or not, and if that person can answer you in like less than 5 seconds, right? You probably want to question the the quality of their answer lah, because anybody who can like all the YouTuber, all the streamer, like somebody this stock can buy or not, then they go and look at the chart for like 1 minute, they see the chart already. Oh, this one resistance cannot buy. Like if you are gonna follow those kind, then I mean, it's not going to work out well. So I'm sorry, I can't answer any of the this one can buy, that one can buy questions. Because we don't recommend anything unless we done the work. Will you be able to share this recording, as I was late cause I was landing from my trip? Yeah, yeah. I'll be posting the recording on our Discord channel here. It will be posted here under public area 2026 outlook and potential play. So you can that I posted a Discord link just now. You can go and download it. I will be sending the Discord link in Facebook tomorrow also lah. So you can definitely access it. What do you think about penny stock? Penny stock, like penny stock has many definition. Like what would you consider a penny stock? So I'm guessing you are saying penny stock in terms of US market, okay, not the Singapore market. So in US market, when we say penny stock, right? Of course, the term penny stock is any stock lesser than $1 lah. That's penny lah. But from the way professionals see it, we don't classify penny stock in terms of the share price, but rather we will classify it from a market capitalization perspective. So one of our criteria when we are looking for stock is we will try to look for something that is higher than 1 billion market cap. Anything lower than 1 billion market cap is definitely a no-go lah, because it's too speculative. The trading volume is very thin. The option chain don't have any options, or the option spread are very wide. We cannot get any kind of a good risk reward ratio, any good thesis out of stocks that are below 1 billion market cap. But anything above, like those stocks that are sitting somewhere around maybe 1 billion to 10 billion market cap, right? Those are very high volatility stocks. Also, we look at them. We look at them quite occasionally. In fact, when Palantir was at $6, it was probably considered a penny stock also. I mean, we are not looking at things like Beyond Meat. We are looking to YOLO Beyond Meat, like go to the moon, short squeeze, those kind of stuff lah. So when we look into the small market cap space, right, we look at it from our framework lah. And if the fundamental is sound, if it pays off, then definitely it's a fair play lah. It's a fair play. We have entered a lot of so-called penny stock before, and like if they goes in our direction, they goes very well in our direction. They go up like crazy lah. Let me try to find one example of a penny stock. Used to be a penny stock, probably. Excuse me. Oh yeah, correct. Thank you, Microvast. Thank you. Yeah, I was thinking, hey, there's a battery company we traded not long ago. What is it? Yeah, so Microvast here, this is definitely a penny stock, but the fundamental is there. So when we bought it, right, I believe somewhere here, somebody profited like, I don't know, 100% from this. This is oh, it's already less than 1 billion market cap. Yeah, thank you, Microvast, correct. I think there are more also. There are definitely more. Holy crap, Chemo is going up 5%, yeah. SI times 7%. Entergis, I just shared only today up 3.39. Don't FOMO, don't FOMO. I think Zim is a penny stock also in the past, 2.65 billion. Previously, sometime in early 2024, we have a long position on Zim here. We actually long here, and then we held through this, and then after that we got rewarded handsomely. Any more questions? Come, come. I like value added question. Value added question in the sense that like I like to answer because it's actually a very good question. So that's why I don't really like to engage like can buy this, can buy that, because those are very like okay, if I say can buy, then like you want to buy now or what? How do you utilize time interval? Can you like expand it a little further, because I'm not sure if I understood it as how you understood it. Like, are you referring to the chart, or are you referring to my holding time frame? Like I said, right? We hardly pay attention to technical because our selection criteria is not technical. It's more of timing criteria. But even from a timing perspective, right? We don't really care so much. We see, okay, this one like up, okay, then bullish, we enter. Basically, that's about it. So, if you recall our slide earlier, our holding time frame is around 30 days. Okay, our average is around 30 days for the holding time frame. Sometimes it can go up to like 40 days, but average around 30 days. So, because of this, right, we always operate on a daily time frame. Okay, nobody in the professional scene operate lower than daily time frame. Those that operate lower than daily time frame, they are called algorithms who are doing market making. So no matter what kind of traders you are, even if you are a retail trader or a forex trader, right, you shouldn't operate anything below the daily time frame, because once you go into 1 hour time frame, 15-minute time frame, you are exposed to a lot of noise, a lot of market making algorithm that is showing a lot of noise, and the technical doesn't make sense at that level. It's like quantum physics, like everything makes sense when it's huge, but once you go down to that small scale, right, no, nothing makes sense. You're welcome. Any more questions? Don't be shy, don't be shy. Okay, if by 11:15 there's no more question, then I'll be ending the session. So for those who feels like okay, you got no more question, you want to leave, you can leave lah. Okay. Thank you. Thanks for coming. For those first timer here. Thank you. Welcome. Thank you so much. Thank you, Ian. Have a great weekend. Yeah, have a great 2026. Thank you. Bye bye. Have a good night. Okay, guys, it's 11:15. Thank you for coming. I'll be uploading this both on Discord channel and on Facebook. So go and take a look. Okay, go just pay attention to your notification from our group lah. Okay. I try my best to keep our group free of all the spamming and all the advertisement nonsense lah. Okay. I mean I myself will advertise lah, but you won't see any other advertisements lah. Okay, guys. Have a great year ahead. Have a great weekend ahead. Bye bye.